Forget everything you've been told about investing. Forget the confusing jargon, the terrifying charts, and the so-called experts who get paid to make you feel like you're not smart enough to build wealth on your own. They want you to trade, to time the market, to listen to their sacred predictions, all while they skim huge fees off your money. But what if I told you that their entire complicated game is a lie? What if the absolute laziest investors are the ones who consistently end up the wealthiest? It sounds insane, but it's the simple truth. In this video, I'm giving you 5 dead simple, set it and forget it rules that will help you build life-changing wealth and retire well before you turn 60. This isn't about getting lucky, picking the next genius stock, or gambling on crypto. This is the real-world roadmap for the rest of us. For anyone who wants their money to work harder than they do. For years, I bought into the hype. I watched brilliant people tie themselves in knots, trying to outsmart Wall Street, believing they had to be the next Warren Buffett to even have a chance. They were glued to their screens, stressing over every headline, and paying fortunes to fund managers who, get this, rarely even beat the market. When I finally cut through that noise, I had a lightning bolt moment. The most powerful strategy wasn't about doing more. It was about doing less, but with robotic consistency. This is the lazy way, and trust me, it's the smartest rebellion you'll ever stage. First, you need to flip the entire goal of investing on its head. The biggest lie ever sold is that you have to be a stock-picking wizard to get rich. You're told to hunt for the next Amazon, to time the market perfectly, buying at the absolute bottom and selling at the absolute top. Here's the unfiltered truth. Almost no one who tries this succeeds. Not just beginners, but the pros in their $1,000 suits. Year after year, comprehensive studies like the SPIVA reports prove it. The vast majority of actively managed funds, where a star manager is paid a fortune to pick stocks, fail to beat a simple, unmanaged index fund, especially after their fees are taken out. Over a 15-year period, it's not uncommon for 85% or more of U.S. large-cap active funds to lag behind the S&P 500. The solution? Stop playing a game that is rigged against you. A lazy investor's goal is not to beat the market, it's to become the market. You are simply aiming to capture the slow, steady, and incredibly powerful growth of the entire economy. It's less stressful, it's cheaper, and history has proven it's far more effective. Rule 1. Automate your wealth machine. The lazy investor's secret weapon is automation. This brings us to rule number 1. Put your wealth on autopilot. We will use a strategy called dollar cost averaging, or DCA. It sounds official, but it just means you invest a fixed amount of money on a fixed schedule. When the market is high, your $500 buys a few shares. But when the market is down and everyone else is panicking, your same $500 automatically buys more shares at a discount. Think of it as a bill you pay to your future self, the one who is sitting on a beach, retired at 55. This simple habit is a game changer for 2 reasons. First, it rips your emotions out of the driver's seat. You'll never be tempted to panic sell during a crash or get greedy in a bubble, because your investing is just happening in the background. While this strategy doesn't guarantee a better return than investing a lump sum, it is an incredible tool for managing risk and building discipline, which is the heart of this entire philosophy. Second, it turns market dips into your friend. You automatically scoop up more assets when they're on sale, lowering your average cost over time. This is the core of lazy investing, building a machine that works so you don't have to. Rule 2. Buy the whole haystack. So your money is flowing automatically, but what are you actually buying? Wall Street wants you to search for the needle in the haystack, that one miracle stock. A lazy investor knows that's a fool's errand. Our second rule is brutally simple. Just buy the whole haystack. You do this with low-cost, broad market index funds, or ETFs. An index fund is just a basket that holds a small piece of every company in a major market index. The most famous one is an S&P 500 index fund. When you buy a single share of an S&P 500 fund, you instantly own a tiny piece of about 500 of the biggest, most influential companies in the US. It's crucial to understand this isn't just a random list. It's a curated selection representing every major sector of the economy. This gives you the ultimate lazy superpower: instant diversification. You aren't betting on Apple or Ford. You are betting on the long-term success of the entire American economy. If one company fails, it barely registers. This is the cheapest, simplest, and most effective way to become the market. By the way, do me a quick favor and hit the like button, and it helps this video reach others who are tired of being confused. Rule 3. Play the long game, the lazy investor's math. We have an automated system buying the entire market for us. Great. But how does this get you to an early retirement? The answer is our third rule: play the long game and let the magic of compounding do all the heavy lifting. There's a famous quote that calls compound interest the eighth wonder of the world. Imagine two friends, Sarah and John. Sarah starts investing at age 25, putting $500 a month into an S&P 500 index fund. John thinks he has plenty of time and waits until he's 45 to start. Sarah's portfolio could be worth over $850,000. John, who started just 20 years later, might only have around $150,000. That gap isn't just a number on a screen. It's the difference between retiring early and working an extra decade or more. Time is the most valuable asset you have. So how much do you need? A good starting point is the 4% rule. This guideline suggests that you can safely withdraw about 4% of your portfolio in your first year of retirement, and then adjust for inflation each year after, with a high probability of your money lasting. To get a rough target, multiply your desired annual living expenses by 25. If you want to live on $60,000 a year, your goal is a $1.5 million nest egg. But, and this is important, the 4% rule was designed for a traditional 30-year retirement. If you plan to retire at 55, your money might need to last 40-plus years. For that reason, many experts now suggest a more conservative 3.5% withdrawal rate to be safer. Think of this rule as a landmark on your map, not the final destination. Rule 4. Master your own psychology. This brings us to the fourth and by far the most difficult rule. You must master your own mind. Your biggest enemy in this journey isn't a stock market crash. It's the face in the mirror. The market will crash. It's not a question of if, but when. There will be days, weeks, or even years when your portfolio value plummets by 20%, 30%, or more. Your stomach will drop, your heart will pound, and every instinct will scream at you to sell everything to make the pain stop. This is panic, and it is the precise moment the lazy investor wins. While there's no guarantee the market will always recover, the broad U.S. market has, so far, come back from every single crash in its history to reach new highs. But that recovery can feel agonizingly long. After the 1929 stock market crash, it took the Dow about 25 years to return to its previous peak in nominal terms. And after the dot-com bubble burst in 2000, the tech-heavy Nasdaq took a full 15 years to reclaim its high. But the lazy investor system is built for this storm. Because you automated everything, you just keep buying, scooping up more shares at bargain prices without even thinking. Because you bought the whole haystack, you aren't worried about one bad company. Your only job is to do nothing. Ignore the headlines. Delete the stock app from your phone. Go for a walk. You have to trust the system you built and let time do its work. Rule 5. Your lazy investor starter pack. Okay, let's stop talking and start doing. Rule number 5 is your actionable starter pack. Here's what you can do today in less than 30 minutes. Step 1. Open the right account. This advice is primarily for U.S. viewers. If your job offers a 401k with a company match, you must start there. That match is a 100% return on your money instantly. It's free. After that, open a tax-advantaged account like a Roth IRA or a traditional IRA. Step 2. Pick your investment. Do not overthink this. Choose one or two broad, ultra-low-cost index funds. A total stock market fund like VTI or an S&P 500 fund like VOO are perfect one-and-done choices. Step 3. Set up your automatic investment. This is you turning on your wealth machine. Decide how much you can consistently invest each month. Then set up that automatic transfer from your bank. It doesn't matter if you start with $50. The only thing that matters is that you start. Step 4. Now for the most important step. I'm half joking, but I'm also dead serious. Forget your password. The entire point is to set it and forget it. Do not tinker. Do not trade. And for the love of your future self, do not check it every day. Let the machine do its job for the next few decades. And that's it. That's the secret. 5 simple rules. Stop trying to be a genius. Automate your system. Buy the whole market. Let compounding do the work. And get a grip on your own emotions. The financial industry profits from complexity and chaos. They want you to believe this is too hard to do on your own. You now know that's not true. Building real wealth for an early retirement isn't about a magic formula. It's about relentless consistency. It's about a simple plan executed without fail through sunshine and storms. That is the lazy way. And it's the most powerful way I know. Your future self is going to be incredibly grateful you started. Now, I want to hear from you. Drop a comment below and tell me, what's the #1 thing that's been holding you back from getting started with investing? Let's talk about it. And if you want more guides to build wealth the lazy way, make sure you subscribe and turn on notifications so you don't miss what's next.